Can you believe it? We have just over 3 months left in 2024. Time has been flying by so quickly. If you're like most people, you might be realizing that you're not quite on track to hit your money goals for the year. But here's the good news, there's still enough time left to hit some financial goals and finish the year quite strong. So the topics in this video are actually very similar to the topics we have covered in previous videos as well. This video is for those who haven't watched those or similar videos, or it'll act as a refresher for a lot of us. Let's begin. Let's start with something we have discussed so many times on this channel, that is maximizing contributions. So this section of the video is all about maximizing your contributions to your tax advantaged accounts. The three primary ones we'll discuss today are your TFSA, RRSP and FHSA. Let's start with the TFSA account first. If you have a TFSA or you are opening one for the first time, you'll want to contribute as much as possible before the December 31st deadline. For 2024, you can contribute up to $7,000 plus any unused contribution room from previous years. You can simply go to CRA to see what your allowed limit is, or you can also use a calculator like this one. The TFSA is my favorite account because it's one of the most powerful tools available for Canadians. This is because all investment, growth and withdrawals are tax-free for life. This actually makes it the best account for any short, medium or long-term goals. So if you contribute to your TFSA right now, you'll have more time to grow your money over the course of your life as well. Even if it's 3 months more, it can add up quite a bit. Usually I tell people that the TFSA is the best account and that's the one they should start with. However, because we are already in September and we only have 3 months left, the other two accounts might be better choices right now. These accounts are your RRSP and FHSA. Let's start by looking at your RRSP first. For your registered retirement savings plan, you have until February 29, 2024 to make contributions that count for the 2024 tax year. So unlike the TFSA, you actually get 2 months extra to contribute to your RRSP and still make it count for 2024. I generally don't do this because I like maintaining my finances from the 1st of Jan till the last day of December. So just as a reminder again, the limit is 18% of your 2023 earned income with a maximum of 31,560. You also have any unused contribution rooms from previous years. So as we know, the RRSP is designed for retirement savings. Contributions are tax deductible, which can reduce your taxable income and result in a tax refund. For example, if you're in the 30% tax bracket and contribute $10,000 to your RRSP, you could get back about $3,000 in tax refund. This is why it's so important to ensure that you're getting your tax refunds in time, because once you have that money, you can invest it again and let it grow over a period of time. As a reminder, these accounts are not completely tax-free for the whole of your life. Once you withdraw it, you are actually taxed on it. So basically, it's a tax-deferred account. However, the sooner you start using it, the more time you have to actually let your money sit there, but also enjoy the tax benefits of it. So if I had contribution left for my TFSA and RRSP at this point in the year, I would be prioritizing my RRSP first. However, there's one more account that was introduced last year, that is the FHSA account, that is the First Home Savings account. So I believe if you're somebody who qualifies for this account and has intentions of actually buying a home one day, this might be the best account to start with. If you're saving for your first home, make sure to take advantage of this account. You can contribute up to $8,000 per year and $40,000 lifetime to save tax-free for your first home purchase. The reason this account is so great is because it combines the features of both the TFSA and RRSP. Basically, contributions are tax deductible like an RRSP, but withdrawals for a first home purchase are tax-free like a TFSA. And even if you end up not using this money, you can eventually transfer it to your RRSP later on. So I believe the FHSA is actually a win-win situation for those who qualify. So you can open an account, enjoy the tax refund and the tax deferred growth, and later decide what you really want to do with the money in this account. Just to put things into perspective, an $8,000 contribution to your FHSA can give you back about $2,000 when you file your taxes next year. Then you can reinvest this $2,000 again. But also, as a reminder, you have to do this before December 31st and you need to take a decision as soon as possible. So if it was up to me and I had all three of these accounts, I would first prioritize the FHSA, then the RRSP, and then finally the TFSA. At this point in the year, it's more important to plan your tax refunds rather than your tax-free growth. So as we approach the end of the year, it's also a good time for portfolio rebalancing and optimization. Let's look at some of the key things that we should be thinking about. The first one is fixing investing mistakes. The one particular mistake I want to talk about is if you have bought US dividend stocks in a taxable account, now is the time to fix them. For anybody who doesn't know, US stocks held in a Canadian account have a 15% withholding tax. The only account where you do not have a withholding tax is actually your RRSP. So if you want to hold US dividend stocks, RRSP is the right account to hold them in. This is actually one of the mistakes I fixed last year and made sure that I was not buying any of these stocks in the taxable accounts. There are also plenty of other things that you should consider when buying US stocks. Feel free to check out this video if you want more information on this topic. But let's look at the other thing that you could be doing, that is tax loss harvesting. Another strategy is to sell some of your losing investments to offset any capital gains you have. This can help you rebalance your portfolio and reduce your tax bill. So this year has been pretty good for the stock market. However, we all hold some losing positions. So if you have some positions that are definitely not going up and have been bad investments for you, feel free to sell them and realize some of those gains as well. In case you have never employed any tax loss harvesting, just look at it this way. If you have $5,000 in capital gains and $5,000 in capital losses, you can sell the losing investments to offset the gains. This could actually save you about $1,500 in taxes, assuming a 30% tax rate on capital gains. Again, I'm not saying that we should sell some of the positions which are not in the green right now. What I'm saying is, if we have losing positions, things that are just not good investments and may not even recover, those are some of the stocks we could actually consider selling. Tax loss harvesting can be very uncomfortable when you do it for the first time. It's quite hard to sell your losing positions. That's why I'm talking about all this right now and not in December. Sometimes we need a little bit of time to figure out what we want to sell. Also, in the 3 months, you might get some good exit points. The next one is actually a very powerful strategy, that is strategic withdrawals. Firstly, I want to highlight one of the qualities of a TFSA. When you withdraw some money from a TFSA, you actually get the contribution room back immediately on 1st January. This can actually serve as a very good strategic tool. Let's say you're somebody with a great TFSA account. You have regularly contributed, you have a lot of growth in those accounts, and you are also sitting on top of a lot of capital gains. Or you are somebody who has a lot of money in your TFSA but haven't invested it so far, or it's sitting in a bank account for some reason. This might be a great time to withdraw some of that account and redirect it towards your RRSP and FHSA if you still have contribution room left. This way you can get the tax refunds as soon as you file your taxes next year, and you'll also get your TFSA room limits back immediately on 1st January 2025. Again, this is something I see a lot of my friends actually employing. If they're falling short a little bit on their RRSP or FHSA, they actually start diverting their money from their TFSAs. For example, if you were to withdraw about 5,000 from your TFSA today, you will get the 5,000 room back next year. On top of that, you'll also get the new limits for 2025. Don't take any sudden decisions. Give yourself some time, figure out if it actually applies to you and there's a way for you to do it, and then take the decision. But it's very important to understand that this is a tool that's available to all of us and we should all use it wisely whenever we need it. So those are the 3 main strategies that you can consider when it comes to portfolio rebalancing and optimization. However, it's also a good time to generally take a look at your portfolio and decide what you want to do with already existing positions. For example, more recently I was looking at some of my positions and I think that they're pretty bad investments, so I'm trying to decide which ones I want to sell off by the end of the year so I can reuse that money. That's exactly what I'm talking about. Take a step back, look at all your investments and start taking decisions over the next few weeks. If you were to suddenly do this in December, you're going to pull the trigger on the wrong things without actually having enough time to think about it. That's why, again, I'm making this video well in advance. So all this is great. As long as you have enough money to do all this, you should be doing it before the year ends. However, I also want to talk about some money saving tips in general. Suppose you have been spending a lot of money this year, this might be a good time to slow down a bit and revisit your goals. So this can be for 2 reasons. One is that you want to become a little more financially stable before the year ends, or secondly, you also need a little bit more money and save a little bit more money so you could do number 1 and 2 that we discussed in this video. So to address that, let's look at some of the strategies you could be employing. Now, none of this are very novel ideas. However, I want to talk about it just to reinforce these ideas. Firstly, the most obvious thing you should be doing is that you should be cutting down on any unnecessary expenses. Take a hard look at your expenses and see what you can cut. Do you have any subscriptions or memberships you're not using? Are you dining out way more than often and you need to stop a bit? Find these areas where you can trim some of the fat. So it might not sound like a lot. However, if there's a gym membership which is costing you $50 right now and you cancel it right now, you might save $150 and you can redirect it towards your RRSP and actually get some tax refund on top of it. When it comes to money, every dollar counts, so even if it might seem like a very small thing, it might be the right decision. The next one is actually to shop smarter. We soon have holidays coming up, and holidays come with a lot of expenses and purchases that you have to do for your friends and family as well. This is a great time to start planning what you really want to buy, because Cyber Monday and Black Friday are coming up and you want to buy them during those times. Don't take abrupt decisions, because even though there's a sale going on, you might end up spending way more money than you actually want to, because because you didn't really plan out everything. For example, I'm already working on my Christmas shopping list so that as soon as the sales start coming along, I can start buying those and be done with it. This also stops me from any unplanned spending because I have a list and I stick to it. Of course, a little here and there is fine, but don't end up buying a PS5 Pro for yourself when you haven't been hitting your financial goals in the first place. There's another way we could all be shopping smartly, that is when it comes to our day-to-day expenses such as groceries. I often come across people who do not plan their groceries at all. They just go to whichever grocery store they can find and start buying stuff there. However, if you were to use apps like Flip, you can actually review all the deals that are available and then take the decision where you want to shop. It might not seem like a lot. How much money can you really save by employing such methods? Trust me, I've been employing these methods for a long time and I've saved hundreds of dollars over the years. And those dollars have actually been invested and have been growing over the years as well. Again, think about it this way. If you typically spend $500 on your groceries, cutting it by just 10% and shopping smarter could save you $50 per month or $600 per year. This $600 can go into your investment accounts or can be used to buy presents for your friends and family. The next thing I want to talk about is automating your savings. Even though it's the end of the year, this might be a great time to start employing some of these money management habits. There's nothing more powerful than automating your savings. If you set up regular transfers from your checking account to your savings and investment account, you're always putting aside money without having to take decision on a regular basis. Again, I want to emphasize that this is a very powerful tool that everybody should be using. This is a great way to build your habit as well. You can start as small as $50 per paycheck and increase it over time as you adjust to living on less. Again, it might not sound like a lot, but if you were to just save $50 bi-weekly, you could be saving $1,200 a year. That's actually still more than what an average person is saving right now. The next thing I want to talk about is that yes, you only have 3 months left, but you still have enough time to make a little extra income. If you want to supercharge your savings and investments or just make a little bit extra money so you can buy gifts for your friends and family, consider making a little bit more money towards the end of the year. This could come through a side hustle, freelancing, or even selling items you no longer need. The last one is something I do quite often. I try to find things that I no longer need and just sell them off. It also helps me declutter on a regular basis. Of course, this one is easier said than done and doesn't apply to everybody, but try to do it if you're in a position to do it. This also makes me think of all the things people aim to do. If they want to start a small business, start freelance consulting. Last 3 months is not a bad time to just experiment a bit with it. You might end up making some money, or you might set yourself up to make money in the future. However, it's a step towards making more money. Talking about the future brings us to the last point, that is plan for the next year. You must be going like, yeah, duh, we should be planning for the next year for sure. But how many of you are actually doing it? Are you really sitting down and figuring out what you did with your money this year and how you want to improve next year? Did you really look at your investments and find all the mistakes that you have made? Have you maintained a journal that you should be reviewing? Have you maintained any notes? Have you maintained any reviews? If not, this is the time to start working towards it. This is also a great time to review your employee benefits and make sure you're taking full advantage of it, especially when it comes to any matching contributions for your retirement. You will not believe how many people are still not taking advantage of this free money that we get from our employers. For example, look at it this way. Some people might get a match from their company. Say you set aside $2,000, your company will also set aside $2,000 for you. If you're not doing that, you're basically missing out on 100% return on your money. It's basically free money or money that your company has already accounted for you, but you're not taking advantage of that. Why not? Make sure you're never missing out on such things. When it comes to planning for the next year, I'm going to make a full video on how we should all be going about it and what can we use to do that. That might be a few weeks away, so feel free to check out the last video that I had made that gives you a one-page simple financial template that you can use for your planning purposes. So no matter what you do, whether you use the financial template or not doesn't matter. What you need to do is look at your finances and figure out how you want to improve on it next year. But if there are things that you could start doing today, as we have discussed in this video, start doing them today. Do not wait. There's so many things that could have been overlooked over the year. There's also one more thing I want to discuss. It's the end of the year. A lot of people might be getting a bonus from their employer. Please do not waste that money. Figure out what really needs to happen to that money and do the right thing. Do not go out and start spending that money immediately just because it's the end of the year. Your friends and family will also understand that sometimes you need to prioritize the long term over the short term. So there you have it, 4 key strategies to employ in the last 3 months of 2024 and end the year strong financially. If we wanted to summarize it in one line, it would be maximize your contributions, optimize your investments, save where you can, and plan ahead for the next year. Remember, small changes can really add up over a period of time. What you need to do is start early and work towards your financial goals consistently. I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.